Welcome to This Explainer. Today, we are stepping right into the ring to look at one of the most high-stakes, heavy-hitting corporate battles happening in the digital world right now. I'm talking, of course, about the massive fight for India's food and grocery delivery market. In the red corner, you've got Zomato, a company that has literally just pivoted from heavy cash burn into a profitable powerhouse. And in the orange corner, Swiggy, the pioneer of the full-stack logistics model, and they are aggressively investing billions to capture the future. Guys, this isn't just your standard business rivalry. It's a full-blown clash of titans, and it's completely reshaping how millions of us eat and shop every single day.
So that brings us to the ultimate question we really need to answer today. Who's actually winning the race to your front door? Because beyond all the flashy marketing hype and those push notification discount codes, what do the hard numbers actually tell us about their financial health, their real market dominance, and their long-term survival? Let's check out the tale of the tape. To figure this out, we're going to break this down into 6 rounds. The great food duopoly, the profitability war, the core delivery battlefield, the quick commerce clash, the impact on the consumer, and finally, the verdict. All right, round 1, the great food duopoly. Let's talk market dominance. It's incredibly rare to see a market as massive and diverse as India, dominated almost entirely by just 2 players. But these 2 digital giants have completely locked down the dining and convenience landscape. Right now, Zomato holds a pretty commanding 58% of the organized food delivery market, which leaves Swiggy with the remaining 42%. But actually, it wasn't always this skewed. If you look back at 2020, they were basically neck and neck at about 45% each. So what happened? Well, Zomato's IPO in 2021 brought in a massive capital injection, and since then, they've systematically gained ground, carving out this distinct 16 percentage point gap we see today.
And that market share lead? It translates dramatically into public market valuation. Zomato's market capitalization stands at an astonishing 2.5 lakh crore rupees. Compare that to Swiggy's 72,000 crore. We're literally looking at a scenario where the public market is valuing Zomato at over 3 times that of Swiggy. It's a really stark contrast, and it sets the perfect stage for our next round.
Round 2, the profitability war. Let's look at the financial performance.
So this is where their strategies diverge the most visibly. What we have here is a classic juxtaposition. On one side, you have a company transitioning into clear profitability, and on the other, a company choosing to maintain ongoing heavy strategic investments. Over the last decade, both of these guys have experienced absolutely phenomenal steep revenue growth. But while their top-line sales are both climbing upward, it's what's happening beneath that revenue that truly separates them right now.
Just looking at FY25, Zomato not only pulled in higher sales, over 20,243 crore compared to Swiggy's 15,227 crore, but more importantly, Zomato actually reported a profit, 527 crore rupees. They have critically transitioned into the green, while Swiggy, well, they are operating pretty deep in the red.
A 3,117 crore rupee loss for Swiggy. Yeah, just looking at that number kind of makes your own wallet hurt, right? But it is really vital to remain objective here. This isn't necessarily a failing business. Rather, it's a reflection of Swiggy's extremely aggressive, high capital burn strategy. Basically, they are consciously bleeding money today so they can build massive infrastructure for tomorrow. Meanwhile, Zomato is focusing on proving to their investors that their model can generate real cash right now.
Moving on to round 3, the core delivery battlefield. Okay, so in their historic and primary battleground, actually getting a hot meal from a restaurant to your dining table, Zomato clearly commands the volume. They're attracting about 2.09 crore regular ordering customers every single month. Swiggy is at 1.51 crore, so Zomato essentially has roughly 58 lakh more people tapping order on their app monthly. And because both platforms charge a platform fee of around 10 rupees per order, this pure volume advantage translates directly into massive, predictable revenue for Zomato. And that volume advantage, it builds directly into superior unit economics. Both companies are using incredible AI technology for dynamic routing, predicting demand, and optimizing their delivery paths. But Zomato is simply executing more efficiently. They boast a 4.4% adjusted EBITDA margin on their gross order value compared to Swiggy's 2.4%. So at the end of the day, every single order just yields slightly more profit for Zomato. Round 4, the quick commerce clash, getting your groceries in minutes. Now, hot food delivery is almost becoming old news. The real war today is happening in quick commerce. And guys, just look at this unbelievable number, 756%. That is the explosive year-over-year revenue growth that Zomato's Blinkit recently experienced. I mean, it's the kind of growth traditional retailers would literally faint over. This unbelievable surge has completely transformed Zomato from just a food delivery app into an absolute quick commerce powerhouse.
If we pit Zomato's Blinkit directly against Swiggy's Instamart, it reveals exactly why Blinkit is surging. When a customer places an order on Blinkit, their average order value is 665 rupees. On Instamart, it's 527. So on average, a customer is spending 138 rupees more per quick commerce order on Zomato's platform. And as we know, higher cart values mean much better margins.
Plus, Blinkit also dominates in pure volume. They're processing around 15.7 lakh orders every single day, while Instamart is handling about 12.15 lakh. That gives Blinkit a solid lead of over 3.6 lakh daily orders. When you combine more daily orders with a higher average spend per order, well, you get a massive revenue advantage. Of course, to process all those massive orders in under 10 minutes, you need serious infrastructure. You need dark stores or mini warehouses scattered all across these cities. Currently, Blinkit operates 1,301 of them, compared to Instamart's 1,021. And neutrally reporting the financials here shows that yes, both are currently losing money in this segment, but the trajectory is what's key. Blinkit has actually managed to cut its losses by a massive 92%, whereas Instamart's losses have increased as they spend heavily to try and catch up.
Which brings us to round 5, consumer impact. What does all of this actually mean for you?
Let's bring these billions of rupees back down to earth and right into your wallet. The reality of a market where just two players exert over 90% combined control, it raises some significant concerns. This is a classic duopoly. For the restaurants, this dominance means they often have very little choice but to pay hefty commissions, sometimes 30% to 40% per order. And for you, the consumer, this lack of widespread competition allows the platforms to comfortably introduce and gradually increase those pesky platform fees and delivery charges.
And honestly, this is exactly why market observers are keeping a close eye on potential disruptors. The government-backed ONDC initiative is often cited as a potential equalizer here. By creating an open network, ONDC could theoretically help new, smaller delivery apps or even direct-to-consumer restaurant platforms emerge. Over time, this could break the duopoly's pricing power, potentially ensuring fairer prices for you and lower commissions for your favorite local restaurants.
Finally, round 6, the final verdict. Who wins?
Based strictly on the data we've covered, what are the implications? Well, let's look through the investor's lens first. The valuation difference is incredibly telling. The market currently trades Zomato at a price-to-sales ratio of 12.2 times, compared to Swiggy's 6 times. Investors are literally willing to pay double for every rupee of Zomato's sales compared to Swiggy's. This points to a much higher investor confidence in Zomato's clear path to profitability and their execution track record, while Swiggy's lower valuation reflects a more cautious market stance given their ongoing cash burn.
So, to recap objectively, Zomato currently holds the lead in almost every single metric. They've got the larger market share, the higher user volume, better unit economics, and most importantly, actual profitability. But make no mistake, Swiggy is not out of the fight. They remain a formidable giant. They're making massive, aggressive investments in Swiggy Instamart and overall infrastructure, betting heavily that this short-term pain will result in long-term profitability and growth.
Which leaves us with one final thought as we close out this explainer. As Zomato seeks to maximize its new profits and Swiggy fights desperately to reach the green, will this fierce duopoly ultimately drive continuous innovation and better service for you? Or will they simply leverage their combined 90% market share to pass the bill to the consumer through higher fees? It is a high-stakes balance for sure, and one we are going to be watching very, very closely. Thank you so much for joining me for this deep dive.